Hi, everyone. Welcome to the Timing Research Show for April 27th, 2015. Today we will be talking about the 83rd weekly report. If you haven't had a chance to look at this yet, just go to TimingResearch.com/reports and take a look at it there. My name is David Kosmeter. I'm the creator of Timing Research, and I have Dave Landry hosting the show for me again today, so I'm going to turn it over to him now.
Okay, fantastic. Thank you, Dave Kosmeter, and thank you for having me host again this week, and thanks to TimingResearch.com. And I don't know if you mentioned or not, but if you haven't already downloaded the report, you can get it from TimingResearch.com. Looks like we've got a full lineup today. Geoff Bysshe of MarketGauge.com. Geoff, tell us a little bit about yourself, your trading, and a little bit about MarketGauge.com. And then at the end of the show, we'll have some more time to wrap things up, too.
Okay. Well,
I'm good now.
I've been trading for about 25 years. I started on the floor of the Commodities Exchange, and founded MarketGauge.com in 1997, along with a partner. And basically, since 1997, we've been providing information as well as training to professionals and active individuals. And we tend to trade stocks and ETFs in systematic ways, either rules-based or completely automated. That's our focus.
Cool. Yeah, somebody was on the show before that was on the floor, and one thing somebody told me was, you look to your left, you look to your right, you wait a couple of months, and if those two people are still there, hang out with them because they know what they're doing. So it's trial by fire, huh? Cool.
That's a good motto.
Cool. All right, next up we have John Nyaradi of WallStreetSectorSelector.com. John's a veteran of the show, but to those of us who don't know you, tell us a little bit about your trading and tell us a little bit about WallStreetSectorSelector.com.
Thanks, David. Always nice to be with you. I appreciate it. And
thank you.
So we spec ETFs and we do position trading, long and short ETFs, leverage ETFs. And I'm working up an options program that we're going to introduce here in a month or so. And we do a lot of publications around some of the major news sites. And that's our same thing, kind of training people and offering trading signals for exchange-traded funds.
Cool. All right, Jim was having some audio troubles logging on. Jim, can you hear me now?
Yeah, I can hear you good. Can you hear me?
Whoa, yeah.
Okay. Well,
I think the whole world can hear you.
Oh God. No, David was saying my voice was coming in very low, so I figured if I shouted, that would clear that problem off the table. Okay, sorry about that.
All right, Jim, you know the routine. Tell us a little bit about yourself, to those of us who don't know you, and tell us a little bit about OptionProfessor.com.
Sure. I've been involved in the options market for over 30 years now, and I've been doing seminars throughout the country and internationally as well. Now, of course, we do a lot on the web now, but I used to go all to different money shows, etc., and try to educate people on the uses and risks of options. As far as the three main areas of the options that the Option Professor DVDs cover, it would be the buy side of options, everything from straight buys to combination strategies, and spreads, and then on the writing side, doing the naked and then the hedge through credit spread type writing, trying to take advantage of time decay on these options. And then the third area would be hedging. The more we get into this rally further and further, obviously some base knowledge on hedging is probably not the worst thing in the world, because although the market indices are making new highs, not all stocks are making new highs, and some people have caught some pretty good runs. Or on the short-term trading, some guys might want to use some options as a hedge against some of the exposures they have. So Option Professor provides the details on all the uses and risks of options, and then the investor is more informed, and then he can apply the information as he sees fit.
Good stuff. Good stuff. Thank you, Jim. My name's Dave Landry. I'm of DaveLandry.com. Like everyone else here, I've been at this for a very long time. I'm a trend follower, but I believe you can only predict the short term when it comes to markets. However, I will stay for positions for weeks, months, and even years as long as that trend ensues. So I take a bit of a hybrid approach. I have a 21-page report on my website. If anybody's interested in that, you go to Store, and then you look under free reports, and you can get that there. Like Jim, I've also been blessed to be able to travel the world to speak the good word on trend following, so that's been kind of fun too. But any questions or anything that I mentioned here, just shoot me an email at dave@davelandry.com. Everything is fully disclosed that I do when it comes to trading. Okay, Geoff, let's go back to you. Geoff, the question 2 is, based on any technical or fundamental indicators you want to use, would you predict that the S&P index will move higher or lower this week? And that's the close of Friday, May 1st. Is it May already? Good grief. And then once you answer that question, rate your confidence to your answer on a scale of 0 to 2, with 0 being no confidence and 10 being extremely confident.
Okay, well, I tend to look at the markets either on a day-by-day basis or a little bit longer than a week. So you've kind of caught me in between here. That said, I think we may have the benefit of today helping me out with this one, because given the way that the markets have reacted to Friday's breakout so far in the Qs, I'm going to say we're probably going to be lower today by the end of the week. In the SPYs. In the Qs, I'm not so sure, but in the S&Ps, I'm going to guess lower. And I'd say, you said a 0, or do you want me to go straight into my confidence there?
Yeah, please do. And then we're going to talk about the markets in a few minutes too, and some more details.
Right. So as far as confidence, if 0 is 50-50, I'm going to say a 5.
Okay. Okay, Jim, let's go to you next. Based on any technical fundamental indicators you want to use, would you predict the S&P 500 will move higher or lower by Friday? And rate your confidence in that question or rate your answer to that question on a scale of 0 to 10, with 0 being confidence and 10 being extremely confident.
Well, one thing you reminded me about, Dave, is don't ever forget where the major trend is, because looking for pullbacks in a major trend is a rough racket sometimes. So having said that, though, I am going to stick with the idea that there's been a divergence in the Russell, the Dow, and the S&P and the transports from the NASDAQ, and I'm going to respect that a little bit this week. And I would suggest that if this VIX gets above 13, 14, and if this market fails to take off through the highs after the Apple announcements, then you got at least a 50-50 shot of going down. But the primary trend remains up, and so that's why these drops in the last period of time have either not come, or they've come and they have been of a short duration. So bottom line is like I say, the answer would be down, and the confidence would be 0.
All right, gotcha. All right, John, to you, same question.
Well, I think, as was just mentioned, the major trend is still up. We saw that we've been in this long sideways channel really since October or November, and it just broke out here recently. So I would say this pullback you're seeing right today is probably a natural response to the recent breakout. Once that consolidation is over, I think higher prices. Apple today, certainly. Janet Yellen on Wednesday, the GDP report. So I'm not super bullish, but I think it's going to go higher. And I've got some long positions on, and so confidence level, medium-ish.
Medium-ish. Can you put a number on that?
Yeah. Well, what's the number for medium?
I guess 5.
5. 5 out of 10. Okay.
5 out of 10. Okay. The longer-term trend so far, I think, is still up. Obviously, one thing that I found fascinating, and one thing I love about the educational business and getting to speak in front of people, is that it forces me to simplify things. And one theme that I've been on lately and just absolutely love is everything works better with trends. So if somebody shows me a complicated methodology that captures a trend, and the trend is there, you could probably simplify that down to something extremely simple. And one thing I've been looking at lately, which is just kind of blown me away, is the fact that if you take a look at the S&P 500, the last 90% or so, we've had only about 5 days of daylight below the 200-day moving average. Now, by daylight, I mean the highs or below the moving average. You can see like a space. Some people call it a window or a gap above or below. And that's kind of fascinating to me. And just a simple trend following thing can work really well when there is a trend. Just like you can't catch a tan when there's no sun, you can't catch a trend when there is none. So I'm going to stick with my longer-term forecast. If you've been with these, if you've been watching these shows for a while, you'll know that as long as the market is at or near new highs, I just say it goes up. And right now, the S&P made brand new all-time highs on Friday. I like what I think Jim pointed out, and I don't know if Geoff also pointed out, but there's a little divergence going on between the NASDAQ and the Russell and the S&P to some extent. So that's a bit of a bummer. And ideally, I'd like to see all three of them at new highs. Like I wrote a column this morning, you got the S&P was at new highs on Friday, ditto for the NASDAQ. So like Meatloaf says, 2 out of 3 ain't bad. So better than poking the eye, I guess. So I'm going to stick with up, and I'm going to give that a confidence rating of about 7. And I think that's where I've been stuck for the last several months. So that's my story, and I'm sticking to it. All right, Geoff, let's go back to you. Question of the week is question every week, I should say, is what developing events, and they can be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, again, in a really short-term way, well, first of all, take a quick step back. Coming from my floor trader days, I have a way of looking at the markets that revolves around looking at how they open, and more specifically, I look at the first 30 minutes. So that expands out to how does a market close relative to the prior day. So for me, the first thing I'm going to look at in this market, I mean, even though I said I thought it would move down, one of the reasons I said that was because I'm looking at the IWMs, and one of the first things I'll look for is the first time that the market closes below the prior day's low. And when that happens, and when it happens on several of the 4 major markets, the Dow, S&P, NASDAQ, and IWMs, that will be the first indication to me that we're going to head lower, or at least start to go sideways. So that's something that when the market's trending up, which it is right now, is on the top of my radar in terms of looking at things. And this, by the way, also works really well on intraday charts and reversals. So that's the first thing I'm going to look at. The second thing that I've got my eye on, and maybe we'll talk about this later in the market from a longer-term perspective, is the global market. Global markets have really perked up. So if we pull back, I want to see how the Morgan Stanley MSCI index, so the ETF for that is ACWI, whether or not that breaks down or pulls back with the rest of the markets. So if that holds up, I think that's a good sign for the U.S. And big picture, those are the 2 things to keep it simple for right now. I'm going to keep my eye on. Oh, I guess one other thing, and that is we've got trend lines coming in from, I think it's the October 14 lows that the S&Ps and the IWMs are kind of flirting with. So if we break those for a couple days, then I'll be more concerned with the downside.
Okay. Yeah, good stuff on the foreign markets. I'm going to +1 on that, and I want to maybe dovetail in on some of the things you said when my turn comes back around. Jim, let's go to you next. What developing events that can be technical or fundamental will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Well, the first thing would be obviously these Apple earnings that are coming out, which could have some effect. But as we saw with Amazon, the thinness of the volume out there, it seems like when these news reports come out, they do huge volume that day. They have a hard time following through because the volume seems to be possibly people that are covering shorts and then market makers raising the offer. And then if there's no buy volume behind it, sometimes these stocks fall under their own weight. I've been looking at the market with the transportation average for a long time. Obviously, it's had a bounce, but overall, it's still been a little bit weaker. because it made its highs a long time ago and nowhere near the high right now. The VIX is something that went way down towards 12, volatility measurement, and now it's trying to press up towards 13. If it went to 14 or higher, obviously we could get some downside there. Looking at the market on a 1-day, 10-day, and 1-day, 5-day, and 10-day basis gives you a little bit of a mixture on what the short-term picture looks like. And so keeping an eye on those three charts, if you're a short-term guy, would be something. And like you guys were saying, Asia is in mania mode with China, and Europe had a very big rebound in the first quarter because the euro was tanking. But if the euro bounces back like it's doing today, and it extends that bounce back, maybe that enthusiasm or those trades that were put on for the export guys, they may unwind some of those. So it'll be interesting to see. So those are some of the things I'm keeping an eye on here this week.
Yeah, good stuff. I agree with you on a lot of that. In fact, I'm so anxious to jump in on China now, but I'll wait till my turn. John, you're up next. Same question: what developing events, technical, fundamental, will you be watching out for next week or this week, I should say? That might have a positive or negative impact on the S&P 500 and other U.S. markets.
Well, of course, we've talked about the Apple earnings today. That'll be the big one. The Fed announcement on Wednesday. Q1 GDP revision. So those are the fundamental kind of things, I think. Technically, if you look at a chart of the S&P 500, everything is in an uptrend. I mean, MACD, 20-day, 50-day, 200-day moving averages, relative strengths above 50 with room to run. Of course, overbought levels of 70. So, I think you have that consolidation today, but generally, the big picture still is looking positive and higher.
Cool.
And we'll see what happens. I mean, it's all about the Fed. I mean, it's been all about the Fed since 2009, and I think they're nervous about the market. They're more Dow-driven. They say they're data-driven. I think they're more Dow-driven. So it'll be interesting to see what they come up with on Wednesday.
Yeah, I think the Fed is painting themselves to the corner, and I've brought this up many times to all the market veterans that we have here. It's like, at what point in time did the Fed go from inflation and interest rates to like trying to make the market go higher? It's like they quit worrying about everything except making the market go higher. And unfortunately, I think they painted themselves in a corner. But I ignore all news, everything, and as I often say on these shows, I didn't know who Yellen was until one of these shows, and my wife tells me stop admitting that. But that's a testament for how much I ignore all news and just look at the charts. As we're doing this program, as I think who was it pointed out? Geoff pointed out, and maybe Jim too. The Russell is diverging, and that's a bit of a bummer. That's one of my favorite, if not the favorite index to watch when it comes to the markets. So I'm going to keep an eye on that Russell and see what happens there. As long as the indices can hang around and remain at or near new highs, I'll be happy. I'd like to see the S&P break out of the range too. But so far, so good in the NASDAQ today, notwithstanding. China, I'm really paying attention to what's going on in China. We're long JMEI, and so far it's been great for us. A lot of people have been poo-pooing China. I was speaking not last Friday, but Friday before at the American Association of Professional Technical Analysts meeting, and I was talking about China, and somebody's like, "Oh, well, you know what's going on in China," and blah blah blah, and I got all excited and worried. And then after my speech, I checked my stock that was long, and it happened to be up. So a lot of people get all excited about China. A lot of problems with China, allegedly and all. But so far, it's a bull market. So far, it's going up. And we get paid to catch trends. It doesn't matter where they are. It does end badly eventually, but that's what stops are for, taking profits and trailing stops. So you stick with them as long as they work. I'm also a big bull on Brazil right now and Latin America. And those I think it's EWZ set up last week. We might have talked about it in this show. Let me see if I can pull that up real quick. So, yeah, I'm a big fan of that. You've got a pattern I call a bow tie off of all-time lows, or at least multi-year lows there, and that's a wonderful pattern to trade. Sometimes you catch the mother of all bottoms with that. Energy is just recently set up as a save sort of thing. We're long TGA in energies as an example of a great stock there. It looks like it bottomed out. Steel and iron, big bull on steel and iron right now. It took off. And in fact, if you combine steel and iron with Brazil, then you got a double-barreled shotgun there, and we're long SID, which just hit some profit targets this morning and did well. So the point I'm trying to make is the indices look pretty good so far. The S&P is a little sideways, and Russell's a little sideways. But I think there's a stealthy bull market going on in these aforementioned areas. Some nice areas are bottoming out. I like the second-tier China stocks that are bottoming out, and there's quite a few that look pretty good. Cup and handles forming there, and also a lot of patterns such as bow ties that I think are worth taking a shot at. Ditto again for Latin America, Brazil. Energy stocks are still bottoming out and looking pretty darn good here. And also, there's a stealthy bull market in IPOs right now. And if you go to my website, I'm doing a webinar tomorrow night on that little soft sell. It's a free webinar though, so it won't cost you anything. But I think there's just been an amazing bull market in IPOs for the last couple of years that I think most people don't even realize what's going on there. So those are the markets that I'm watching. I'm long some China, long some steel, long Brazil steel, long some energies, and also long some IPOs at this juncture. So I think to wrap things up, I think the big opportunities right now are in those lower level stocks that I just mentioned, the IPOs, as opposed to these stocks in longer term uptrends. And then if they could continue those longer term uptrends, such as biotech and areas like that, then on pullbacks I'll look to load and reload along the way. Kind of a long-winded answer, but in general, I guess it sounds like I'm a little still bullish in here. Okay, let's go back to you, Geoff. Question of the week is, and I think based on what we talked about pre-market, you could care about as much about it as I do. But this is the audience wants to know. Okay, inquiry minds want to know. The proposed Comcast and Time Warner Cable merger deal is dead. Oh my God, I didn't know that. Oh. Why I'm in the show? Goodness. Do you think the cancellation of this deal is good or bad for shareholders and customers?
Well, I would say that the answer to whether or not it's good or bad for shareholders is pretty easy for me. Both stocks have pretty much gone up as a result. Neither really enough to be worth watching still, in my opinion. So I guess nobody really liked it. In terms of the customers, honestly, I don't have a strong opinion there, other than I don't think that putting two huge companies together in that industry is going to do anybody, from a customer point of view, any good. Chances are that whole industry is going to look completely different in 2 or 3 years, and everything moves faster than we think. So maybe it's even 1 year from the likes of what Amazon and Netflix and Hulu and all these other content companies are now providing. I'm not so sure we're really going to know who the best provider of the internet is going to be, or content, a year or two out. So what two big guys are doing right now, I don't think from a customer point of view it really matters. Yeah, and the industry is moving so fast. I think the small guys would be the guys to watch versus the big guys. It's like every day I'm discovering new websites and companies out there doing some amazing things. But John, before I go too far, John, let's go to you. The proposed Comcast and Time Warner Cable merger deal is dead. Do you think the cancellation of this deal is good or bad for shareholders and customers? I think John's muted. Jim, let's go to you. He'll have to answer again.
Hey, John, you're muted. You need to unmute yourself.
All right, we'll come back.
How's that? Okay.
Yeah, that's good.
I'm back.
And the secret to trading is.
Yeah, I think the market doesn't care. I mean, you can see that in the stock prices. As
yeah.
Mentioned. I think for the customers, it's probably better it didn't go through in terms of pricing. And there's some areas it would have been almost a total monopoly. Big cities like San Francisco. But the bigger news in that business is what people are talking about. These old line companies are struggling to stay relevant, and the Netflix and the Amazons, like we've talked about, are running away with this thing. And so you can see AOL. Remember, they were like the leader of the internet email, and now they're pretty much irrelevant in terms of what's happened since then. So I think there's a real survival of the fittest. You have to adapt or die, and I think these guys were trying to they can't adapt because they're too big, so they're trying to get bigger. So it's gonna be a very interesting struggle to see how this all shakes out. And like you said, it's moving so fast now. It's a really exciting time for all of us, I think, in terms of this is sort of the Gutenberg moment again, with the internet being as disruptive as the Gutenberg Bible was, and especially this switch now to mobile, that we're seeing.
Yeah, I mean
So,
over the weekend I had to install an app on my website because Google said, you know what, you're no longer mobile, you're no longer relevant, forget you. So yeah,
yeah.
I like what you said about fighting to stay relevant. Well chosen words there, John. Jim Kenney, you're up next. Same question. The proposed Comcast and Time Warner Cable merger, you tried to say, is dead. Do you think the cancellation of this deal is good or bad for shareholders and customers?
Well, I think like you guys were saying, this is way out of our ballpark. You know what I mean? I'm not following these two stocks at all, so I wouldn't be any good at giving you any strong opinion. But an amusing thought might be that since sometimes the world is round, maybe Comcast dodged a bullet if Time Warner was going to do to Comcast what AOL did to Time Warner.
Oh my God! I read. Did you ever? What I read. Was it Call Me Ted or whatever? Ted Turner's biography. And yeah, he was not happy about that deal. I think it cost him a billion here, a billion there. It adds up after a while. So
that's the only amusing thought I have when I hear those two names.
Yeah.
that and I prefer DirecTV to cable. That's the only thing.
Oh man, whoever I have for cable satellite, I hate them. So I hate them because my wife hates them. That's all that matters, Happy wife, happy life. Yeah, we'll talk about that other stuff later. That's like fodder for a good. Maybe we can have a beer and talk about some of that.
Right.
I don't really care. I like what John said about staying relevant again. Right now, again, I don't know who said it, survival of the fittest, and I think that the small companies are more nimble, and things are moving really fast now. And even the big companies are moving fast, like you pointed out. I think Jim pointed out the Amazon thing. As far as both of those stocks, as far as trading them as a technician, I'm not looking at those kind of stocks. I like these stocks that are making these nice rounded bottoms in here, like these second-tier China stocks, the energies, and everything I already mentioned ad nauseum. And I think that's where your opportunities could be. Both stocks are trading higher, as Geoff pointed out. So that tells you right there. Is it good for the market? It's good. Yes, it's good for the market if they don't merge together. So they're probably better off on their own. But yeah, as a technician, you can't get too wrapped up in those things. Like I often say, don't confuse the issue with facts. And if you do, you're not going to be a very good technical type of trader. Okay. Geoff, let's go back to you. Any closing thoughts could be about anything, about Time Warner, Comcast, about your website, marketgauge.com, your trading, just anything else you want to talk about to wrap things up.
Well, I have a couple of kind of random, or I should say, unrelated thoughts. The first is one of the interesting things about where we are in the market right now is you just take a look at some of the major sectors and their ETFs. SPYs are hitting a new high here, but only one of the other ones is the consumer cyclicals. And I don't know what it's doing today. My guess is probably pulling back with the rest of them. But the reason that I think that's interesting, and if you combine that with the fact that the number of new highs right now is relatively low, there isn't a whole lot of interest in the market up here at the new highs. And while you could make the argument that that's potentially bearish, I think that it cuts either way. I think if the market starts to take off here, we've got a lot of stuff that has consolidated and looks like it has a lot of firepower to move higher. We just have to get out from this range. I'm not sure what's going to put us out of that range, but if you focus on the stuff that's got good consolidation, if the market breaks out here, I think we can really go higher. Now, that said, until we do that, and I'm kind of reiterating what you've said, Dave, when the market pulls back, I think there's going to be huge opportunities buying the pullbacks. And so that's really where I'm focused. And I'm really focused right when I say right now, over the next, during this period of weeks to months, depending on how long it takes the market to break out, focus on looking for these intraday reversals that have been really nice to just pick off, because the market sells off, and sometimes the sell-off is a day, sometimes it's 2 or 3 days, and then it's right back up. It hasn't been right back up and off to the races, but it's been right back up. And so, just kind of a word of advice, or what I'm doing, is I'm just looking at the first 30 minutes of the day on specific stocks and strong trends, and when we get down and put in reversals near key reference points and near that 30-minute opening range, they tend to pop right back up, and then I've got either a good day trade or I'm in good for a good swing trade. So that's been my focus, and I think that's kind of the way the market's going to continue to trade until we have some significant shift in the perception of which direction our economy is actually going in. And that's my take. If anybody wanted to learn a little bit more about that, you can check us out at MarketGauge.com. More specifically, I've got a free report about it, MarketGauge.com/ORR, as in opening range reversal.
Okay, cool stuff. Kind of reminiscent of what's his name? ORB, opening range breakout. Toby Crable.
Yeah, I'd be a big fan of Tony Crable. I'm a big fan of opening range breakouts too.
Yeah.
I just think that right now in this market, it's just so much easier to buy the dip than to buy the breakout. But either one works if you know what you're doing.
Gotcha. All right, good stuff. Okay, Jim, let's go to you. Any closing thoughts about your trading, the market, or OptionProfessor.com? The floor's yours.
Okay. Well, I think education's the key here. So learn as much as you can before you get in there. On a short-term basis, the market may be in a situation where it's hitting the upper end of the range and it could roll down. Maybe the biotech sector backing off is giving us a tip that might occur. That's something interesting to keep an eye on. Intermediate and longer term, the moving averages still seem to be pretty positive, so strategies that are neutral to bullish still make the most sense at this point. On a bigger picture, China does look good from the standpoint of moving higher, but it is getting into that 60% bounce off the lows that we had in 2007, 8, or whatever. So, obviously none of these indicators are pointing down, but monitoring them as they get up into these higher regions. The thin volume is something to keep a little bit of an eye on, because we had like 3-4 times regular volume on Amazon. The 50-day average volume is 3 million shares. 3.8 million is the 200-day, so that looks a little thin. Apple has 5.8 billion shares outstanding. They trade 49 million on a 50-day average, 53 million on a 200-day average. So you just think if anything did occur and wanted significant selling into those, the volume versus the shares outstanding seems very, very out of whack. So hedging strategies would be something that I think would be worth knowing about in the next 12 months. And strategies right now in a neutral and bullish area might be the most reasonable. So education's the key. The Option Professor DVDs go over both use and risk of a whole bunch of strategies, sometimes using different size contracts like the E-mini and the S&P big one in concert is an interesting thing to look at. And so there's a lot to learn on this stuff, and what we try to do at Option Professor is educate you first. So take advantage of webinars and the DVDs when you see them out there.
Amen. And a lot of moving parts with the options, so you've got a big task to keep everybody educated in that. And plus one on that, I would encourage everyone to get educated, especially when it comes to options. So good stuff over there at Option Professor. Thank you, Jim. John, let's go to you. Any closing thoughts? Anything else you want to tell us about Wall Street, SectorSelector.com, the markets, or how are things up in the mountain, or whatever else is going on over there in your neck of the woods?
Yeah, it's good spring skiing right now. So, but I think generally bullish, like we've been saying. Although you can't get like too bullish. You look at the percent of stocks on buy signals, the BPNYA. It's almost 70, so that's getting up into the red zone for being overbought. So I think, moving ahead cautiously is the key, and certainly exchange traded funds, like we've talked about, give you a chance really to develop your own hedge fund in a way, and that's what we try to do with that diversification that the ETFs offer. That retail investors can do things we could only dream about a few years ago in terms of asset classes. So it's an exciting time to be here and doing what we're doing.
Cool. Okay, looks like it's to me. A couple things that just to kind of circle back to the market just for a second. One thing that I love, and I saw this not last Friday, but Friday before, the market began to sell off a little bit, and the bears come out of the woodwork. I call it the Chicken Little update. I do that every now and then when I write my column, and it's just amazing how many people are bearish, how many people bet on this market to fail, and they've been doing that forever, or at least since 2009. Since the bottom in 2009, and so far the market has obviously gone up significantly since then. Sooner or later it's going to end. The trend always ends, and it usually ends badly. But if you're trailing a stop, if you're taking profits along the way and finding opportunities and making money, who cares? And that's the main thing you need to focus on. Like Jim said, education is key. I'm a big I love the educational business. Even from a selfish standpoint, I love it because it makes me focus on the markets. It makes me focus on what truly is a trend. It teaches me not to outsmart the market. So from a selfish standpoint, I get a lot out of that too. As mentioned, I think earlier, I do have a webinar tomorrow on IPOs. IPOs have been hot, and I think it's been a stealthy hot for a long time, for years. And there's been a stealthy bull market there. It might end tomorrow, but I think the information is good to know because there'll be other bull markets and there'll be other IPOs that will take off. I also do, just FYI real quick to wrap things up, I also do a weekly webinar every Thursday, usually at 11 o'clock Eastern. It's Dave Landry's The Week in Charts, and you can find the countdown on my website there. Anything you want to ask about trading, bring you questions. Usually I lecture based on current conditions, talk about the opportunities I'm seeing, and last week we talked about steel and iron, China, and all these other things I just mentioned, and knock on wood, so far so good on those. So the webinar, my goal is to make it relevant, and so far I think it is, and hopefully will continue to be that way. Anyway, I think that's good for me. David Cosmitter, let me turn it back over to you.
All right. Thanks, guys. Just want to remind everyone watching that you can download the current report or any past reports at TimingResearch.com/reports, and also next weekend or later this week, sometime before Sunday afternoon, be sure to go to TimingResearch.com/current-survey to fill out the survey for Sunday's report. And I want to thank my guests, Geoff Bysshe of MarketGauge. Thanks for being on for the first time. And John Nyaradi of WallStreetSectorSelector.com and Jim Kenney of OptionProfessor.com. Thanks for being back. And, of course, Dave Landry of DaveLandry.com. Thank you for hosting again.
Thank you, Dave Cosmitter, and I want to thank everybody else for being here this week. Thank you guys so much. You guys made a really good show this week, so I want to thank you for that.
Thanks a lot, Dave. We'll see you soon.
Thank you.
Thanks.